that Russia is pursuing a liberal policy in terms of gold ownership during a currency crisis, it probably means they're setting up for a big move in their currency system to something hard and pulling the rug out from under the feet of the West. Hello there, my friends. Rafi here from the Endgame Investor coming at you with this week's silver report for Arcadia Economics. It's a day later than usual coming out, but there's a good excuse for that, and the excuse is silver. Yesterday was the Jewish holiday of Purim. I was celebrating. I went to a party. It is the tradition on Purim to give charity in the form of silver coins. Why? Because the Jews were sold for silver on the holiday by the Persian Empire, tried to kill us all. We won, and we have a party. Today, we're going to talk about today's silver report, brought to you by BlackRock Silver. BlackRock Silver is a silver exploration company centered around Nevada, very heavily invested by institutional ownership, including First Majestic, Eric Sprott, as you can see here, Crescat Capital, Sprott AM, Gold 2000, and MMCap. 59% of the float is owned by institutions, 37% by retail. Stock has been doing very well as silver has taken off, and Eric Sprott has just invested another $5 million in the company as of 2 weeks ago, March 3rd. We can begin here with what happened this week in the technicals. All that it was is a retest of the 50-week moving average. You can see here the blue line. It was at 24.62. We bounced off of that yesterday. If we can close above that line this week, the weekly charts will be painted bullishly, and this will only just be a mild retest of an important technical line. Yes, we want the short-term bull picture on our side to give us a little tailwind, and we might just get it. We'll see what happens. In other news, the New York Fed released its one-year inflation expectation statistics again, and they're up to 6% from 5.4% last month. That was a surprise jump for them, and this hasn't even taken into account the increase in prices due to the Russian invasion of the Ukraine. What is important here to understand is that the one-year expectations are taking off and separating from the three-year expectations, and that is a sign that people are really starting to worry. But put it this way, when you're in a hyperinflationary situation, you don't care what prices are going to be 3 years from now. You care what they're going to be 1 year from now. You care what they're going to be 6 months from now. So the shorter time frames go higher and higher in their expectations, and that is a sign that of approaching hyperinflation. We are getting very close to that. Next, you see here a long-term chart of the yield curve spread. This is the difference in rates between the 10-year rate and the 2-year rate treasuries. See, every time that this red line, the zero line, the spread between those two rates goes below zero, you have an economic crisis. In 1990, it was a mild recession. And then in 2000, when the yield spread went negative, you had the dot-com burst, which was a lot more serious. Then you had the 2008 great financial crisis, which was even more serious than that. And then you had a very brief dip below zero in September 2019, when the Fed was last tightening. You had the Repocalypse, when overnight rates jumped to 10% in one night. And now here, you have a touch of the zero mark, and now we're at 0.26. But if the Fed continues to hike rates, then what we will have is this line going below zero, and the next economic crisis is going to be the mother of them all. Oh, now here's something interesting about that. Joseph Wang was quoted by Mishtalk, and Joseph Wang is a Fed trader. He trades the QE programs. He says, according to Mish, I am getting a sense there will be a very aggressive steepening of the curve engineered by the Fed by very aggressive quantitative tightening. Why? Because he thinks that the Fed does not want the yield spread to go negative as it is going now, or very close to it. He further says, you have housing going up 20%. That's not normal, right? A lot of people cannot afford homes anymore. The way that you touch housing is not by hiking the Fed funds rate. People do not borrow mortgages at the overnight rate. My guess is that if you do aggressive enough QT, quantitative tightening, that it will bleed into the 10-year as well. So what Wang is saying is that the Fed is going to try to bring housing prices down by selling off long-term bonds. By doing that, they will collapse the banking system, because the commercial banks are so full of long-term paper that if you bring yields up on the long-term paper and the prices of those bonds go down, the bank balance sheets are going to start bleeding, and the Fed's equity itself, the Fed's balance sheet itself, which is also loaded up with this paper, is going to start bleeding. So they're talking about sacrificing the banking system. I don't know if they realize that, but that's what's going to happen. And now we turn to silver in Russia, where you see the silver price in Russian rubles pretty much tripling nearly to 4,400 rubles an ounce. And silver is saving lives in Russia. Why? Because most people cannot afford gold, and they need something to preserve what wealth they have left. And that, for most people, is silver. This is what happens in every currency crisis, and it is going to happen in the dollar crisis, which is just around the corner. So have your physical with you. Meanwhile, in gold, we have what remains a record short position, all-time record net short position by the bullion banks, who hold almost all of the net shorts. These are not companies, these are not mining companies that are hedged, these are banks that are shorting gold that supposedly have their positions backed in London. But if that gold that is supposedly there is double owned or triple owned by ETFs and the Bank of England, then there's going to be a big fight over it, and you're going to have a gold crash in the paper markets, just like you saw with nickel and the LME, which, by the way, has not started trading again. It's shut down again after opening up for a few minutes. Maybe even more important than the record short position by bullion banks, you see here that the price collapse in gold since topping out at around 2070 last week has not led to much of a drop in open interest. That's unlike what happened over here in late 2021, when open interest briefly pushed above 600,000. The number of contracts open, futures contracts open, pushed above 600,000 and then fell sharply into that price collapse. But this time, open interest is still way above 600,000, which means that the shorts cannot close their positions despite the price falling, which means that the speculators are hanging on. The CPI came out this week, and what really matters here is this paragraph from the CPI. The food at home index rose 8.6% over the last 12 months, the largest 12-month increase since the period ending April 1981. The index for meats, poultry, fish, and eggs increased 13% over the last year, as the index for beef rose 16.2%. So the food inflation rate really shows you what the actual price inflation rate is, or much closer to it than the broader CPI, which includes prices that don't exist, like owner's equivalent rent. Finally, I want to go into what Russia is doing with its gold purchases, and Chris covered this in a previous video. I highly recommend watching it. This is from Reuters. A Russian central bank halts purchases of gold from banks to meet household demand. This is a very interesting turn of events, because if the central bank were panicking, it would forbid gold sales outside of its own gold purchases, but the Russian central bank is doing the opposite. It is trying to enable its people to buy gold, which to me says one thing, and that is that eventually they are going to move the ruble onto a gold standard. The Russian central bank said it will suspend the buying of gold from banks from Tuesday to meet increased demand for the precious metal from households, its latest attempt to weather the storm on Russian markets in the face of Western sanctions. Currently, households' demand for buying physical gold bars has increased, driven in particular by the abolition of value-added tax on these operations, the central bank said in a statement. That is phenomenal. That Russia is pursuing a liberal policy in terms of gold ownership during a currency crisis. It probably means they're setting up for a big move in their currency system to something hard and pulling the rug out from under the feet of the West. That's what this tells me. That's what is probably coming. Exactly when, I don't know, but Russia understands that this is primarily a financial war, and that it is much more able to deal with financial calamity than the West is, or that the United States and Europe are, because they are so full to the gills with debt that a move to a gold standard by the ruble would end the dollar as the reserve currency of the world. This is Rafi of the Endgame Investor coming at you with this week's silver report for Arcadia Economics, and I'll see you guys next week.